Hello, everybody. Welcome to Thursday. The S&P 500 was up almost 0.5% today. And the big news today was the release of the Consumer Price Index. It's a major index that is used to look at how much inflation we might be having. And today it was up 5% higher than it was last May. And that's a big number. Actually, I have to go back to 2008 to see that kind of jump, in 1 year. But last May was in the middle of the pandemic and prices were actually going down. So year over year comparisons right now aren't as accurate as normal. But month over month comparisons are probably still worth looking at. So if you look at, the movement from March to April, which was the last report, 0.9% growth. That's pretty high. This time from April to May, the report that came out today was up 0.6%. So that's better. Maybe things are slowing down a little bit, but it's still very high. If you kept going at 0.6% for a full year, you'd be at 7.2% for the year. And the Federal Reserve has a target at around 2%. And they're willing to let the market and the economy run hot before they start to make adjustments to their bond buying or their interest rates. But that's one of the fears. And so normally you see the market kind of reacting negatively to that. But not today. Let me show you something here that I think is very fascinating. I talked a little bit about this yesterday. So this is the 10-year Treasury market, okay? And that's the current yield, 1.46%. And here's the chart of the yield or the interest over the last 3 months. And you can see here at the beginning of the year, boy, things just really took off. And we really, really went up a lot and hit a high here, at the end of March. Well, but if you look at what's happened right now, these highs are getting lower and lower and lower. And then we kind of set a low down here that we broke through yesterday and we continued down today. So what the bond market is saying is that it's not worried about inflation, even though we just had the report and it was fairly high. And, even on a historical basis was fairly high. The bond market yield is going down. And so the bond market is signaling that it is looking at inflation as possibly temporary, or at least with what we know so far, not as bad as everybody thought it might be. And so that's very fascinating. And so then if you see what happened to the market, here's today. The pieces that did the best were the growth portion. So again, in a high inflationary environment, these actually should do fairly poorly. But the bond market is signaling that doesn't feel like inflation is going to be a big threat here, at least in the short term. And we saw a pretty good move here and a kind of a selling off of the value, which has been doing quite well. If you look back over the last 3 months, these are two of the bigger areas that today sold off. And again, these areas, this kind of mid cap and small cap value, are the more economically sensitive. So if the economy grows quickly and if there's higher inflation, you'll generally see these areas doing better in a higher inflationary environment. And also a lot of the reopening stocks that we talk about all the time happen to be in this category also. So really fascinating to see, what has happened here, where high numbers on the CPI, bond market is okay with that, starts to actually lower the interest rates, which would mean that it's not as afraid of inflation. And we start to see the growth things do well. So what we saw today within our accounts, for example, the taxable accounts we have still have a lot of those growth pieces. We still have Apple and Microsoft and all of those pieces that were quite green today. Those did quite well. Our models are more geared towards the reopening and inflation sensitive area. We did make a couple of changes to those. We're always making changes to kind of balance that out, but they didn't do as well today. So we'll have to wait and see how this plays out. But these are really important pieces. And again, I'll mention, like I said yesterday, keep an eye on that 10-year Treasury yield. Kind of gives you a really good idea, for what might be coming in terms of inflation. So I think one of the things that they saw in the inflation numbers that made them feel better was that roughly a third of the increase in inflation had to do with car prices and used car prices. And there's a big demand, big shortage due to, the chip shortage that's happening. And so, once that works its way out, I suppose the market is looking at that and saying, okay, that's going to be temporary. There is one big plant that burned down in Japan that's supposed to be coming back on in July. So I think these are things that they're anticipating as far as that goes. So very interesting day, something to watch for and continue to watch and see what happens. And look forward to seeing you tomorrow. Thank you very much.